Okay, so today we are going to talk more about risk management and trading psychology, and this is what you have to understand when it comes to this trading industry. Hey, ladies and gentlemen, my name is Osei Godfred. You are welcome to this official channel, and here we talk more about cryptocurrency, we talk more about forex trading, we talk more about AI, artificial intelligence, we talk more about how to also make money, how another side hustle business for yourself. So if you want to reach my DM, you can feel free to contact me of any of my social media handles over here. But make sure you subscribe to the channel so you don't miss any updates I will bring up to you. Okay, so let's continue with this video. When it comes to risk management and trading psychology, many people think trading success comes from finding a perfect trend or perfect indicators. But in reality, risk management and emotional controls are what keep traders alive for the long term. This industry is a long-term decision. So you need to be make decisions very well so you not catch yourself blowing your account or losing your capital. Even when it comes to losing trades sometimes, the skilled traders also do lose trades sometimes. So the difference is how you manage your capital properly or how you manage your losses properly. Now, let's continue to the process of protecting your capital. Now, when it comes to this trading industry, the first thing to know very well is protect your capital. Yes, your first goal is not about making huge profit. Your first goal is how to stay in the game for longer time. Today you lose trade, tomorrow you have to get an account to trade again. So don't be losing your capitals over time. Your first goal is staying in the game for a longer time. This is a long-term decision, not a short term. So if you lose all your money, you can't continue to trade or you can't continue to learn. That is what you have to understand. So when it comes to you risking on trade or taking a trade, you need to work with understand what is meant by risk ratio or risk per trade. So let me explain this one for you to understand very well. When it comes to risk per trade, professional traders usually risk only a small part of their account to one trade. So let me give you an example. Example, like you have a trading account of $100 and then you are asked to risk, you are supposed to risk 1:2%. Okay, 1:2%. That means that the maximum loss per trade is $1 or $2. Hope you understand what I'm trying to mean. So your maximum loss per trade could be $1 or $2. That is 1:2%. So if you want to raise, if you want to take at least let's say 5 trades in a row, that means your maximum loss for those 5 trades should be $5. So each trade you are going to lose $1 per trade. That is how it is. So your risk amount is equal to your account size multiplied by your risk percentage. So when you enter the market, you should know the risk percentage that you prefer to risk or the percentage that you prefer to risk, okay, on the market. So you will not end up blowing your account. Now, what is a stop loss? A stop loss automatically exits your trade if the market goes against you. Now let's take it for instance. If example I place a buy on BTC at let's say BTC 95,000, okay, and then BTC and I place my stop loss at 92,000. So 95,000, 92,000, and let's say I leave the trade. I was not around on my chart, and even if I'm on my chart I wasn't focused, or even if I'm focused, like the trade went against me, let me put it that way. So I was predicting for buy and then it goes for sell and then it hits my stop loss. So instead of me losing my all my capitals, trade rather closes automatically for me on my behalf. Either I was aware or wasn't aware. Either I was there or I wasn't there. That is how it is. So stop loss protects your capital and it limits damage on your account. Okay, so and it's help you to prevent over risking. That's how you have to understand very well. Now, when it comes to risk to reward ratio, Good traders often aim for higher reward than risks. Now, risks to reward ratio. Now, let's take it for instance, like I have $10 and I'm expecting a potential reward of $30. So I want to have a $10 account and I want to flip that $10 account to $30. Or let's make it for instance, I have $100 and I want to flip the $100 account to $300. So depends. So this is when you take a trade for instance. You know when you take trade for instance, one trade you could lose some trades and you can also make profit from some trade. I hope you understand that. So let's take it for instance, like my $10, I want to flip the $10 to $30, or $100, I want to flip $100 to $300. Now I'm going to go by the risk to reward ratio, which is 1:3, which means that I'm risking 1% of my trade to make sure I gain the amount that I want to, I want to get. So let's take it for instance, like I'm having $100 account and I want to make $30 from it, for additional $30 to my $100 account, making it 130. Or have $1,000, I want to flip it to, let's say, 1,300. So I hope you understand what I'm trying to do. So I have a $10 account, I want to flip it to, so when it comes to like this, something like this, it means that I am risking 1%. 1:3 means that I'm risking 1% to gain 3% on the market. Hope you understand. So I'm risking 1%. Whenever you hear 1:3 reward ratio, it means that I'm risking 1% to have a return reward of or profit of $3 or 3% from the market. Hope you understand that. So even if you lose some trade, profitable trade can still overweight the losses. Yes, that is how risk to reward ratio works. So 1:3 reward, 1% trade, 1% risk to 3% reward ratio. Hope you understand what I'm trying to make. Now let's go to never put all your balance into one trade. That is position size. I want you to understand when it comes to position sizes, it's very important. Now the position sizes, the lot size matters when it comes to your position size. But before we dive into the lot size matters, let me explain this one for you to understand your smaller positions and then how you enter a trade. Hey, I want you to take your time, check your account balance whenever you want to trade or you want to enter into your trade. First of all, check your account balance. Very, very important. Check your account balance and then make sure you check your entry. Now, when you are done with these two, okay, make sure you check the lot size you are going to use. Never go all in a trade. Now let's take it for instance, when I mean all in on a trade, let's take it for instance, you have $100 account and you want to trade GBP USD or USD JPY, this type of pair, you want to trade them. Now, and then you want to use a lot size of one lot size, or two lot size, or three lot size. So if the market goes against you, it means that you are going to lose all your capital. You have to understand that you are going all in. Now when it comes to the safer idea that I want to give you is that, now if you are going to trade USD JPY or GBP USD, these two pairs, or even XAUSD, so these pairs, whenever you want to enter a trade, make sure you go according to your lot size. I mean, you go according to the sizes of your account. Your account balance is small, so you need to go small, or it should be good to go in small. Don't go all in, because what is very risky is that, the funny thing is that when you go all in on a trade and you end up losing your capital, you in the few minutes you end up finding a perfect setup of it you can't trade anymore. Yes. So don't go all in. The goal is to stay in the market a longer time. The goal is to stay in the game for a long period of time. Hope you understand what I'm trying to mean. Now let's go. The market attacks emotions. That is the psychology part of this trading industry. Hey, if you haven't subscribed to my channel, please do it very well for me. Do it now. I want you to subscribe to. Just hit the subscribe button for me. Just a few minutes. Hit the subscribe button for me. Thank you for hitting the subscribe button. And I want you to also like this video so we can proceed to the next stage. Now, the next stage I want you to understand is the trading psychology. When it comes to the trading psychology, the market attacks emotions consistently. Now, what are some of the emotions that exist in the market? We have the fear of missing out, we have the panic sell, we have the revenge trading. These three are killing a lot of traders. In fact, a lot of traders end up blowing their account because it happens a lot. It happens a lot. That is where people get duped by the market. Get duped and is scammed. I don't want to use the word scam, but permit me to use the word scam, because let me show you something over here. Fear of missing out. Let's say buying because price is pumping rapidly, and then you are buying it. You saw price pumping rapidly, and then you enter for a buy. Then the market overturned. What will you do? The market overturned, which means that it overturned to from buy to sell. What will you? So panic selling. So we are selling because price dropped suddenly. You saw it price dropping suddenly, and then you enter for sell, and then the market reversed. What will you do? So okay, let me put this one to you for them that understand very well. When you try revenge trading, revenge trading is whereby you have made losses in the market and then you emotionally wants to recover it. So you are entering into the market with a huge loss size. You are entering into the market with many open positions like ba 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 ba. You know, you want to recover, and then still the market reversed against you, or even if it hasn't reversed against you, the market is not going as you are expecting. You are still in loss, and then margin catch you, and all of a sudden your account balance is gone. What will you do at this stage? So that is what is trapping a lot of traders in this forex trading industry. A lot of beginners are getting trapped in this, but you need to study yourself very well. That is why I do recommend, when you want to start trading, please again, try yourself with the demo account first to know and experience the market very well before you enter with a real account. Yes. And then on your first stage of entering the real account, if you haven't made your first $100, know that that is a learning stage for you guys. So you need to stick to whatever you are doing. Now, patience is a skill, and good traders wait for, first of all, clear setup. If the market is not giving you a clear setup, don't trade. Sit down, watch the market going up and down, don't trade. Now, you need a good risk reward ratio, you need a confirmation too. Do not try to force trades constantly. Do not try to force a trade to work for you. Don't try. Yes, don't try. Because if you try to force trade, you'll end up losing something you are not willing to lose. Now, avoid over trading. Avoid over trading. I repeat, avoid over trading. More trade does not guarantee you more profit. Sometimes the best trade is no trade. Yes, sometimes the best trade is no trade at all. So more trade does not guarantee you profit. So avoid over trading. Now, when it comes to this aspect, if you haven't liked the video, please like the video for me. Just few minutes. I want you to like this video for me. Have you liked the video? So we should continue. Let's continue. Now, hey guys, when it comes to trading journal is very important. Now, one time I will do a video of how to journal your trade, and I will give you very simple example of it, and we'll go much more about it. The type of application, the kind of application you can use to journal your trade, so that you can have a successful trading journal for yourself. Okay, so what is the importance of trading journal? Trading journal gives you a reference of whatever happened in the market. It shows you the mistake you ever done. It also gives you understanding of what happened based on whether you trade based on emotions, whether you trade based on whatever the reason why you entered the market, the reason why you are in loss, the reason why you are in profit, what really happened, and a whole lot of stuff. So I want you to understand that. So when it comes to trading in general, you need to have your entry, you need to have your exit, you need to state why you entered the trade and what you learned from the trade. Okay, this helps you improve decisions and making over time. It helps you improve decision makings over time. Hope you understand that. And also, this is a trading rules that I want to give to beginners. If you want to start trading, or if you are into trading, or you are making losses from the market and you need some kind of rules, so always use stop loss. Some people do not use stop loss. That is why you end up losing your account. Always go with stop loss. Most of the reason why people are losing and blowing pro firms is that they do not go with stop loss. They don't trade with stop loss. They just saw the market buying and then they buy, saw the market selling and then they sell. That is why you are going to lose a lot of money. So always use stop loss and risk small amount. Okay, just risk small amount on the trade and avoid emotional decisions. Stick to a plan. Avoid emotional decisions and stick to a plan. And then focus on consistency. Yes, that is the best rule I can give you. My name is Osei Godfred. If you haven't subscribed to the channel, please and please again do well to subscribe. Now, the common mistake most beginners make when it comes to trading is they use high leverage, they use high loss sizes, they trade with emotions. I have shown you the three types of emotions that are available. We have the fear of missing out, we have the revenge trading, and then we have the panic of selling. So you have to know that. So don't trade with emotions. And then investing money needed for bills should be avoided. Don't invest your money that you are going to use to pay your bills. Don't invest money of which you can't afford to lose. You can't afford to lose. You know that this amount of money, if I lose it, there's something going to happen to me. I won't eat today. I won't sleep today. I can't sleep. I can't pay the debt. I can't do this. I can't do. Don't trade with such money. Make sure you find money that you can be able to lose it, even if you can afford to lose it. I hope you understand. And then don't go on internet or social media and copy influencers to trade. Now you saw a post on Facebook, you saw a post on X, which is Twitter, you saw a post on Instagram, and then you want to, it says good buy, it says good sell, it says GBP USD buy, it says NZD, it says this, and then you want to go with it, you are going to lose your money. When you see something on the social media like a signal, let's say BTC sell, BTC buy, BTC USD this, USD that, don't trade with such. Cut it off. Okay, cut it off, so you not end up blowing your account, and then chasing 100 times coins consistently will not be make you profitable trader. Now this is short information I would like to give you. Now the healthy trading mindset is every trader should think calmly, every trader should think logically, and every trader should be patiently, you should be patient on the setup. You should think long term, not short term. And then also the practical text before, this one is for you. If you can try your hands with it, I think you can beat the market. So before entering a trade, ask yourself, where is my stop loss? How much am I risking? What is my target? Am I emotionally right? Or does this trade follows my plan? So with this, I think you can beat the market. And then small controlled gain over time are more suitable than gambling for quick wages. Yes. So control your small account in over time, not a quick time, but small over time, consistently. Be consistent on the market. So with this, I think I can have to end here. And hey, if you haven't subscribed to my channel, please subscribe and like this video for more. See you guys. Thank you.